A new takeover target for Verizon. The cable giant rumored to be eyeing a purchase of Disney. This is according to a report in the New York Post. Joining us now is David Kudla, the founder and CEO of Mainstay Capital Management. Holy Moses. I guess they want content, right? Is what Verizon potentially would be paying for?
Yeah, they want content. Content is king. When we look at where all this is going and we look at the telecom companies, they want content.
I'm always suspicious of these deals when you try to marry a content provider with a service provider. They just never, they don't seem to work. The classic one was AOL Time Warner, right? AOL went out, bought Time Warner. One of the worst deals of all time. And yet, you still see it happening. How do you explain that?
Well, they're looking at what is their path forward. You know, in a case like this, that content is needed to build out and go forward.
You know, everyone looks at what Netflix is doing and they say we need content too. Netflix was always thought of like, oh, it's a service, but now they are a maker of great content that people must have. We have AT&T buying Time Warner again, and now we're hearing Verizon for Disney. The problem is with something like Disney, every time we hear the stock goes down, people say, and consumers are cutting the cord. They don't need ESPN anymore. They don't need to pay for it. So I think that's really the quandary here. Can Verizon really get value out of it? I think they're really just shooting in the air, hoping they hit a bird or something.
I mean, I think the difference with Netflix is it's doing it organically, right? They're not going out and buying some other content provider and trying to fold them into their business.
Right.
But it's Netflix and it's Amazon and it's Hulu and it's Facebook and it's Apple potentially getting into the original content business. The quality of the quality goes down and the costs go up, and it's something that all of these companies are going to be grappling with. Traditional media companies, traditional television networks, and certainly these newfangled players. So let's talk about the NASDAQ just snapped a 7-month winning streak. Some weakness in technology lately, but where does the market go from here, David, in terms of, because the NASDAQ was still up more than the other major market gauges in the U.S. for the first half of the year?
And we think there's a reason for that. When we look at the markets overall, this has been a year of growth over value. We're struggling with how much the economy is going to grow, struggling with Trump policies, what will actually get enacted, and the value plays that did so well right after the election have waned in the first half of the year, and it's been the companies that really have that secular growth story, and that leads us to technology. Technology has been strong in the second half. We think it continues to be strong going forward. And there are people that are concerned about how far technology stocks have come. They look at price. We have to remember to come back to valuations. You know, back in 2000, we had nosebleed valuations of 70 times trailing earnings. Now we're around 23, 24, a little bit higher than the S&P 500. But when we look at earnings going forward, 11% for the sector this year, 10% for next year. Technology a place you want to stay with.
How do you explain what's driving the market right now? Is it earnings? Because when you look at other factors that usually matter, interest rates, they're going up not only in the United States now, they're going up elsewhere in the world. The president's agenda, which was the original impetus for this rally, is moving very slowly, if at all. So the market can't look at that. Why have stocks continued to rise?
The important thing that we have this year versus if we were talking about this a year ago, we were coming through a period of negative earnings growth. We now have very strong earnings. 14% earnings growth in the first quarter. We're looking at 6 to 8% in the second quarter. And over the long term, that's
a slowdown from 14 to 6%.
Earnings growth, but that's still earnings growth. That's an earnings growth rate. We have earnings growth, which over the long term, that's what stocks trade on. They'll trade on interest rates, policy, all that over the short term. But the most important factor is earnings.
What does that earnings growth look like in the second half of the year?
We're looking at, for the entire year, about 8 to 9% earnings growth for 2017. So still a decent second half. And we look for strong earnings into 2018.
Yeah, analysts broadly are predicting double-digit earnings growth next year.
Congratulations on your Barron's ranking.
Thank you.
Excellent.
And you're ringing the bell at the New York Stock Exchange.
You're keen on emerging markets as well, aren't you?
Keen on emerging markets as well. You know, when we do look, we have valuations that are supporting the U.S., or we have earnings supporting, valuations to some degree in the U.S., but we still have a CAPE ratio in the U.S., cyclically adjusted price to earnings multiple of 30. We look across to emerging markets, that number is only 14. So we have a lot better value when we...
CAPE is a measure of valuation.
Measure of valuation, measure of, are stocks expensive or cheap? And you could say by that measure in the U.S. right now, stocks are fully valued, maybe expensive. So on a relative basis, we look overseas to emerging markets. We think that's going to be a great sector for the next several years.
David, thanks for being here.
Thank you.
Happy 4th. David Kudla from Mainstay.